Hello everyone, my name is Joe Scorsone, channel is called Ethernet Link, and in today's video I'm coming back with another Quant Connect tutorial. I'm going to be talking about the kind of algorithm someone asked me to make months ago, and I'm just now getting into it, so I apologize for how long that took me, but college and some other work has been consuming quite a bit of my time, but whatever, we're gonna get right into it. So what this algorithm does is that once the SPX reaches its 200-day moving average, what it'll do is buy a put and a call with the trailing stop loss. So here's how you can do that in Quant Connect. I'm going to do this in the format of explaining all the code I have here, and then I'm going to provide a link for this discussion forum, so that way you guys can come in and get all the code, add to it, whatever you would like. So in our initialize, we're going to go by function. So we'll end with on data. We'll go initialize, universe, our options functions, and then we'll get into on data. So right here, setting our start and end date and our cache, pretty standard. Right here, we're saving an instance of XPX into this variable index and storing the symbol version of it into self.xpx. This is basically just so that way we can always have its data in one little variable right there. Next thing what we're doing is we're adding options for self.spx pretty much, and we're also setting the symbol for options. We're storing that in a variable. We're also setting a filter for those options, and we'll get into that in a second. Right here, we're making a simple moving average for XPX, for something really. We're just making this variable a simple moving average for 200 period, and then we're registering the indicator. And what this will do will allow us to specify what symbol we want to use it for, what indicator it actually is. We just have to have this that way it knows, and then the resolution. And this is really cool because we can set this to be daily. We can set this by the minute. We can, if I want a 5-minute moving average, I can just say like time delta 5, or no, it's like min time delta equals 5. It's something like that. I'll get back to you guys on that. But yep, right now we just have it as daily. And then if we get down here, we actually don't need these. I do it a little bit differently now, so we don't need these tickets, but I guess it's nice to have an entry ticket. And entry time, we don't need that either, so we'll actually get rid of that. So and then we need to add the risk management. This is just the simplest way I thought to have a trailing stop loss, 15% off the bat. And this is just so that way we don't have to write a bunch of complicated code to do this for us. We can just add that one liner, it's already there. No need to reinvent the wheel. However, if someone does have a good framework for trailing stop losses on multiple open positions with points, not with percentages, please let me know. I'd be really interested in that. But that concludes it for our initialize method. Just to recap it really simply, we're just adding SPX to our program, to our algorithm. We're adding options for it. We're making a 200-day moving average, and we're adding risk management for a 15% trailing stop loss. Next thing we're doing, this DEF universe func, is we're setting a filter for the options, so that way we can only select from options with the strike 1 to 2 standard deviations out of the money. So we're always buying out of the money on options in this, and they're always expire within 45 to 50 days. Next, we're going to go to the buy call function. This is just standard. I think I just copied and pasted this from somewhere in Quant Connect's documentation. But what we're doing is we're getting the chain, the options chain for this symbol. We're doing a little bit of error handling. If there's no chain, we're just going to return. Then we're sorting them by expiration. We are selecting the call option with the furthest expiration right here. And actually, no, we're not. We're just sorting them by, we're getting the calls right here, and then we are sorting them by the last price. That way they're in order, and then we're selecting the first ones. So this is the closest to the money call option with the furthest expiration is what we're getting with all of this. And then we're just market ordering 5 of them. And this function is the same exact thing, but we're looking to get puts. And so just change up some syntax, and you got puts. Now to get to the onData method, we're checking if there actually is data for SPX that we can use. We're checking to make sure our indicator is ready, because if it's not ready, then we can't do nothing. It's the whole thing the strategy trades off of. This block of code is checking to see if there is an option invested, and if it's about to expire, then just sell it before it expires. And then right here, we're just saving our indicator value into a variable, so that way we won't have to type this long thing a bunch. And then we're going to get into this line right here, at SMA, and then is this conditional? So the intuitive thing to do is just to say, like, if we're at the SMA, is if well, we need to do this self.securities, because we're gonna do it off the symbol, because the symbol is the only thing that has the self in front of it. If we did self.index, then we could just say like self.index.askprice, but whatever, it's just a little bit more code, and to just work with the symbol, like, it's fine. But the intuitive thing to do is just to say equal equals level. However, that's not reliable, because let's say it just never actually let's say the price of SPX actually never equals the simple moving average on a candle close, but it's at the moving average, right? It might even tap it, might even go through it, but it'll never equal it on a candle close. Our algorithm won't work right. It won't presume that as it's actually at the moving average. It won't think it's there, because it's not actually equivalent to it, right? And so this won't work. Well, it'll compile, it'll run, but it won't work the way you think, because it just, like, let's say the moving average is at like 4,450 cents, and the candle closes at 4,400 even. You're not at the moving average. You know what I mean? And then let's say next candle closes at 4,401 and 25. You're not at the moving average. Let's say it closes at 4,475. You're not at the moving average. You know what I mean? But you are. You actually are. You still want to do something in that scenario. So that means you'd have to ditch that and use something like this line of code, where it's greater than the moving average minus 2 points, and it's less than the moving average plus 2 points. So it's in between a little gap in the moving average. Instead of checking to see if it's actually at the moving average, we're giving it a little wiggle room. If it's within 4 points of the moving average, we're at the moving average, and it'll trigger as an actual event. So then we're going to say if we're at the moving average and we're not already invested, buy a put, buy a call. And that's all you need to do. Because of this up here, it'll add a trailing stop loss for 15% for both the put and the call. We don't have to write a fancy on order event method to achieve this. And if you were to run this, this is the return that you would get. I didn't put a lot of money on the trade. It doesn't go with a lot of the account at all, but this is the return that you would generate using 5 contracts. You see at one point it hits a high of a return of 8%. Again, I'm not using a lot of size here at all, but you would have an average win of plus 1.66 and an average loss of just 0.69. So that's actually, let's do the math in fact. So let's get our calculator up here. It's 1.66 over 0.69. So you have a profit factor of over, well, we'll say a profit factor of 2.41. So that's really good. For every dollar you lose, you make $2.41. So that's actually pretty great. It's over 1 to 2 risk to return. So with a 1 to 2 risk to return, you need to win 33% of your trades to make money. We're over that, and we're winning more than 33%. So that's why we're profitable. We have a drawdown of 5%, and we trade 56 total times. If we want to look at this, it's just very, very simple. It'll just does. It just does what it wants to do, and it'll always have that good bracket order because of the algorithm framework. And yeah, we don't have to write any fancy, crazy, complicated models. It's all already there for us. Please don't reinvent the wheel with everything that you do in algorithmic trading. It will hurt you way more than it will help you. But yeah, that's how you can buy a put and a call whenever an equity or an index of this or that hits its 200-day moving average, and also provide a trailing stop loss for it. So if you guys enjoyed this video, please let me know what else you guys would want to see, and I'll try and get back to it in. That looks really weird. I think I've always had it on 110 now that I zoomed out. That was funky. But if you guys enjoyed this video, make sure to subscribe, make sure to drop a like, make sure to ask me whatever you want me to build in Quant Connect. If you can't figure anything out, if you need some inspiration, you want me to make something weird, just throw it at me. I'll get to it. It might take me a few months, but I'll get to it. There'll be a link to this discussion forum in the description where you guys can add to this, do whatever you would like to it. I'm also going to put the source code in a pinned comment. But yeah, let me know what else you guys want me to make. Hope you guys enjoyed the video and have a good one.